Okay, so hello everyone. Now in today's class, we are going to do our question from December 2022. That's called the TOPANTAU company. So I'm opening the exhibits. TOPANTAU is a publishing company currently publishing mathematics and business study texts and online study materials for schools. Companies considering entering new markets in these subject areas. Initially, it will produce material for mathematics degree courses, but then it plans to produce material for other university courses and professional qualifications. TOPANTAU's directors feel that decision to invest. Just a second, please. So it states TOPANTAU's directors feel that decision to invest being made in phases, and the possibility of not pursuing the investment further if sales of mathematics materials are disappointing are significant. However, they are unsure how to incorporate these factors into investment appraisal. TOPANTAU's directors are also uncertain about whether its closest competitors have any plans to enter these new markets or how its competitors will react if TOPANTAU is successful in entering new markets. Okay. So this exhibit gives you some basic information. Okay. The basic information is that TOPANTAU is a publishing company. It currently publishes mathematics and business studies texts. So the important thing to note, it's publishing mathematics and business study texts, online study materials for schools. Okay, mathematics, business study text, online study materials. Companies considering entering new markets in these areas. Initially, it will produce material for degree courses. At the moment, it's just for schools. It will produce material for degree courses, and it plans to produce material for other university courses as well as professional qualifications. Directors feel decision to invest being made in phases. Okay, that we are making the decision in phases, and possibility of not pursuing the investment further if sales of mathematics material are disappointing. Okay, they're also feeling that whether the decision to continue or possibility if mathematics material degree courses are disappointing are significant. Okay, they won't pursue that if initial sales are disappointing. However, they're unsure how to incorporate these factors. They're also uncertain about whether closest competitors have any plans to enter these markets or how its competitors will react if it's successful in its new markets. Okay. Next exhibit, deals of investment. TOPANTAU's board has set a 4-year time horizon for consideration of the investment based on current plan for producing new material. Planned capital expenditure on this investment will be as follows. In year 0, it's 20,000, year 1, 20,000, year 2, 12,000. In addition, working capital required at the start of each year will be as follows. In year 1, 2, 3, 4, start working capital is required at the start of the year, so end of previous year. Okay. Working capital is expected to be fully released at the end of year 4, which happens. Okay. Now, this is the total working capital required, right? Not the incremental required, it's the total required. Okay. So it's fully released. Forecast after tax, pre-tax profits of the investment are stated below. They're stated after deduction of TAD, which is equal to accounting depreciation. Okay. These are pre-tax profits and they're after deducting that TAD. Okay. So sales less cost of goods sold less TAD, you get pre-tax profits. TAD is given and pre-tax profits are given. Taxes payable at 20% there in which profits are made. Botfar is a company which produces mathematics and business studies material for university and professional exam courses. Botfar's debt to equity ratio is 25/75. Its equity beta is 1.6. TOPANTAU's debt to equity ratio is 40/60. This is something I think useful for this WAC stuff. Risk-free rate 4.25%, premium 5.5%. For the purpose of estimating cost of capital, it can assume that debt beta is 0. TOPANTAU's debt consists of 6% bond, which is a nominal value of 100 and premium of 4% on redemption in 4 years' time. Coupon of the bond is payable on an annual basis. Annual spot yield curve for the bond is as follows. For year 1, 2, 3, 4, the spot yield curve is given. That's it. Requirements. So first requirement, evaluate the financial acceptability of the proposed investment. You all know this is done via NPV. And if some assumptions are present, this is done via APV. So there is no conditions of APV, I think. So financial acceptability via NPV and then some discussion. Okay, so we will first find the financial acceptability through NPV. Okay. Okay, now let's evaluate the financial acceptability, which has to be done via NPV. So I need to, I think, close this tab first to create relevant discussion. So let's start with NPV here. Now, again, I've told you multiple times, one approach is that capital allowance approach, that you first make a capital allowance schedule, then you make NPV table, and then sales less cost of goods sold, material, labor, variable fixed overheads, you get taxable profits, then tax, then working capital, then scrap, and in the end show tax savings from capital allowances. Okay. And secondly, the approach is TAD, where you don't show capital allowance tax savings, just deduct TAD to get profits, pay tax, and then add back TAD. Okay, you can use whatever approach you like. So since in the past papers we have gone through TAD approach, we will continue that 4-year time horizon. Okay. Capital expenditure is in each of 3 years. So you need to make sure you don't write it like this, that it gets added into your taxable profit and disturbs your taxable profit and tax, because remember, definition of taxable profit is sales less material, labor, variable or fixed overheads. No working capital, no scrap value, no investment comes in the calculation of profit. Okay, so that's why I always write working capital and the scrap after the calculation of tax. So make sure their investment is in 3 years, so you are familiar with that. Okay, so 4 years time horizon. That means it should be 0, 1, 2, 3, 4. So let's start with pre-tax profit, because you are not given sales or variable cost or fixed cost to the taxable profit. Directly pre-tax profit is given. So we will start with it. Don't write investment first. What is the reason behind that? I will tell you shortly. So pre-tax profits are already deducted with the depreciation 8,700, 11,600, 15,200, 15,500. Okay, so this is basically the pre-tax profit, which we get after using sale less variable cost, less fixed cost, and deducting TAD. Then we pay tax. I think the tax rate is 20%. So it should be treated as an outflow in which the profits are made. So same year. C2 steric 0.2 should be negative. So sales less variable cost, less fixed cost, less TAD gives taxable profit. Then we pay tax, and then we add back the TAD. Remember, this has been our schedule: sale less variable cost, less fixed cost, less TAD. We get taxable profit, pay tax, and then add back TAD. So TAD figure is 2,600, 5,200, 6,700, 6,700. Okay. Now after TAD, we have scrap working capital. Okay. So let's see. There is no scrap value, I think. Yes, no scrap value. So working capital at the start of each year. So start of year 1, 3,000 is required. you will mention as working capital and working capital recovery. So 3,000 at the start of year one means year 0, 3,000 negative. Then it's not incremental, right? Total working capital at the start of each year, at the start of year 2, 3, 4, 5, 0, total is required. That means, yeah, start of year 2, end of year 1, 3, 4, 5, 0 is required. You have already put 3,000, so 450 more. Okay. Then total required is 4,000. Okay, at the start of year 3. In year 2, you will put 4,000, but already 3,000 and 450 are put, so you will put 550 more. And then at the start of year 4, 3,800 is required total. So end of year 3, 3,800. You have put how much? 3,000, 450, 550. You've put 4,000. You need to make it 3,800. So add back 200. And whatever working capital is there will be recovered in the last year. 3,000, 450, 550, 4,000 invested. Pull back 200, 3,800 is left. Okay. Then scrap value, then tax savings from capital allowances won't come because you have used the TAD approach. And now you can write the investment. In each year, it's minus 20,000, minus 20,000, minus 20,000. I will tell you why didn't I write it before. Let's just don't change the traditional way of doing things. I don't want you to get confused that we are doing something different in this. So investment in all 3 years. Okay. Then no sales variable costs are given. Directly pre-tax profit is given. So we write pre-tax profits. Then on that pre-tax profits, we pay tax. Then add back TAD. Okay, because after payment of tax, we add back TAD. And working capital, investment and recovery, then scrap value. No tax savings from capital allowances because this has been done to TAD approach. Had pre-tax profits not been given, we would have written sales, variable cost, fixed cost, TAD, then taxable profit. But make sure that you are not adding investment figure in taxable profit and tax because tax is just on profits, not on investment. Okay. So this will net it all to get net cash flows, and net cash flows will be the sum of B2, B7, and then you can drag it. One thing I need to correct here is that year 3 investment is not 20,000, it's 12,000. Okay, so you get net cash flows. Okay, now net cash flows need to be multiplied by discount factor to get present value and NPV. But either you can use the discount factor, multiply by that to get present value and net them all to get NPV. Okay, or you can use the NPV function. Okay, regardless of whether I am using the NPV function or I am not using the function and writing discount factor, I will be needing the discount factor. And if you look at the question here, discount factor is not provided here. So you need to find discount factor. Okay, now even if I use the NPV function, I will still be needing the discount factor equals to NPV, bracket open, cells of an NCF from year 1 to year last plus the year 1, and we need the discount factor to be put first. Or I don't use the function, still I will be needing the discount factor. Okay, so discount factor, no information is given. Botfor is a company which produces mathematics and business studies material. So it's a competitor data given because you are entering into a new line of business, right? As per the first paragraph, you are thinking to enter new markets. Okay, so proxies data is given. It's a debt to equity ratio 25/75 and equity beta 1.6. You can get the beta asset, put it in your own results to get beta equity. Okay, and RF is given, premium is given, debt beta 0. Okay, so sounds good, right? So you need to find TONPANTAU's discount factor. TONPANTAU's WACC or discount factor, it's financed two sources, okay, equity and debt. Okay, so TONPANTAU's discount factor will be, or you can say WACC will be, because it's financed by two sources, equity and K into equity portion of the company, E upon E plus D, and plus the after-tax cost of debt, that's KD 1 minus T into D upon E plus D. Okay, this is how TONPANTAU's WACC is gonna work. Okay, because TONPANTAU is financed to two sources, right? Equity, debt. So K into equity portion, K into debt portion, and you need four things for it. Okay, you need E, you need D, you need KE, and you need KD. One minus T. Okay. Now, if I go towards E and D, debt to equity ratio is given actually. (40/60). That means that is 40, equity 60. For KE, what you can do is RF 4% plus RM minus RF, the premium 5.5%. Into beta equity. Okay, you will be needing a beta equity here. You cannot use existing beta equity. It's not given, by the way, but you cannot use the existing one because you are going into a new line. You need a new beta equity, and that new beta equity will be developed via channel of ungearing, regearing. Okay, so what is meant by ungearing and regearing? Okay, you have the competitors' data. Through that competitors' data, you find beta asset of proxy. Through that competitors' data, you find the beta asset of proxy. Okay, so beta asset of proxy will be found as through the beta equation. Okay, you have the beta equation that is beta equity of proxy. What for 25/75 equity by 1.6. Okay, so 1.6 into beta asset is equal to beta equity into E over E plus D, 75 over 75 plus 25, but this 25 gets multiplied by 1 minus T, 0.8, 1 minus 0.2 is 0.8. Okay, so proxy's beta asset will be 25, 1 minus 0.2, 0.8, 20, plus 75 is 95, 75 divided by 95 into 1.6. Proxy's beta asset is going to be 1.26. Okay. And then you put it in your results to put beta asset in our results to get beta equity. Okay. Now, in that case, your beta equity is going to be, you've got the beta asset. Okay. Now you will have an equation given that beta asset is equal to beta equity into E over E plus D, 1 minus T. There is no beta debt. Okay. And then it will get cross multiplied. So beta equity will become 1.26 is the beta asset. Okay. It gets multiplied by your own results. Okay. So 60 plus 40 debt, 1 minus 0.2.8 divided by that equity 60. It's just reverse working. You can write into it as well. Okay. So 40 into 0.8 plus 60. It's 92 divided by 60 into 1.26. Okay. This makes it 1.93. Okay. I have done this directly, but what you can do is you can write the complete ungearing regearing equation. Okay. You can completely write the ungearing regearing equation, and ungearing is beta asset is equals to beta equity to E over E plus D proxy. So beta asset 1.6 of proxy, E and D of proxy is 75, 75, 25, you get 1.26. Put that in our own results to get regearing. Same equation, beta asset is equal to beta equity into E over E plus D of own. So beta asset is now there. Own results are 60-40. Put it, you get beta equity 1.93. And once you have this, you can put RF plus RM minus RF into beta equity 1.93. You will get KE as 14.6%. Okay. So ED and KE are there. Now you just need KD1 minus T. Okay. And once you get KD1 minus T, you will get WACC, and then you will get the NPV. Now for KD, we need to find what is the category of debt. So debt consists of 6% bond, which has a nominal value of 100 and premium of 4% and redemption in 4 years' time. That is redeemable. Okay. 6% bond, which has a nominal value of 100, premium of 4% on redemption in 4 years' time. That is redeemable. So it will be through IRR approach, right? So debt is redeemable in 4 years. You can get the IRR approach for that 0, 1, 2, 3, and 4. You need 3 transactions. Market value outflow, that is purchase at market value, then after tax interest, and then redemption. Okay. You get NCF, then first discount factor, then second discount factor, then IRR, or using the IRR function. Okay. So IRR approach, because debt is redeemable. Let's apply the IRR approach. So 4% premium on redemption. So redemption would be at 104 and interest is 6%, right? One zero four redemption. Okay. So redemption is at 104 and after tax interest, it's 6%. But after tax will make it 4.8%. Okay. So 4.8% of what? 4.8% of per 100. So the interest income is going to be 4.8 each year. And redemption is at 104. But the problem is I'm not able to see the market value, which is an outflow. So this is what happens when the data is too much compressed, that you need to find everything. That our NPV was going well, that investment, then no sales, pre-tax profit, tax, add back TAD, working capital recovery, NCF. You needed to multiply with discount factor or use the function, but discount factor WACC was not given. So we found that this company, TONPANTAU company, it is financed through two sources, right? 40/60. So we made the equation of WACC, K into equity portion, KD into debt portion. So E and D were given, K RF plus RM minus RF beta equity. There was no beta equity given, beta asset of proxy was given, beta equity of proxy was given. So if you found beta asset, put it in results to get beta equity, get K. Now KD, that was redeemable after 4 years. It was clearly mentioned it's redeemable after 4 years. So IRR. But IRR market value outflow after tax interest redemption. We have the redemption 104. We have the interest 4.8% of par, 6% after tax, 4.8% of par, but we don't have market value. So the last thing I think we need to do is to find market value of bond. Okay. And how do we get the market value of bond? This has been taught to you multiple times in the class, that when you need to find the market value of bond, it's basically the present value of all future outflows associated with the bond, calculated on a before tax basis, okay, and using KD as discount factor, okay. So market value of bond is redeemable after how many years? 4 years, okay. So let's find market value of bond, present value of all future outflows. So bond is redeemable after 4 years. Market value of bond, present value of two outflows, interest redemption, discounted at KD, calculated on a before tax basis. You need to take two outflows, interest, redemption. Okay. Because market value of bond is the present value of two outflows, interest, redemption, discounted at KD. So what is the interest on this bond? 6 each year. Redemption is 104. Okay. You net them all to get net cash flows. 6, 6, 6, 110. Okay. Discount factor is KD. And you are in search of KD here. You are in search of KD here. You don't have KD because to find KD, you need market value, which was not there. Okay. And you're finding market value. It's the present value of two outflows, interest, redemption, discounted at KD. You have the interest, you have the redemption, NCF, but there is no KD. So now the only option left is to use this as discount rate each year. In year one, 4.33%, then 5.15%, then 5.93%, and 6.58%. Okay. So if year one is 4.33%, get the discount factor as KD 1 upon 1 plus R power N. So 1 upon 1 plus R, 0.0433 power 1. Okay. Year two, 1 divided by 1 plus R. What is the R in the second year? 5.15%. So 0.0515 power 2.9044. 5.93% is third year. So 1 divided by 1 plus R, 0.0593 power 3. And then 1 divided by 1 plus R, 0.0658. Power 4. So net cash flows into discount factor will give present value. Okay, so it's B15, steric, B16. Okay, drag it. Total present value of all future outflows. Total present value of all future outflows. The sum of E17 to E17. This is the market value of bond, right? Total present value of all outflows is the market value of bond, and that's it. Once you get the market value of bond, you put it here, minus 101.474 as the market value. Then after tax, interest, and redemption, you get net cash flows. Okay. Now you can multiply with discount factor of 5%, get the first present value, then increase or decrease, then another rate to get another NPV, positive, negative, and get IRR. Or you can simply find KD1 minus T via the IRR function. Okay. So what you can do is you can put equals to IRR, bracket open, NCF for all years. So N13 to R13. Put enter. Convert it into percentage. 5.3%. This is your KD1 minus T. Once you get KD1 minus T, things are almost nearing end. You put it 5.3%. Okay. Now you finally have all the 4 items. You put them in the equation of WACC that WACC is equals to KE. That's 14.6%. Into E over E plus D. So E over E plus D is 60 over 100. Plus KD1 minus D. What is the KD1 minus D? It's 5.3%. Okay. Into D over E plus D. So D is 40 over E plus D is 100. Okay. You get WACC as 10.68% or 10.88%. Okay. So this 10.88% can be taken as 11%, or you can take 10.8% as well. I was waiting for NPV because you have the investment, you have the pre-tax profit, TAD, working capital, everything, net cash flows, just multiplied with discount factor of 11% to get present values or NPV, or you can find NPV via the NPV function, in which it's equal to NPV, bracket open, discount rate. That's 11%, comma, NCF from year 1 to year last. So it will be C8 to F8, bracket cost plus NCF of year 0. That is B8. Okay, this is the NPV. And I will write the financially project is not acceptable because NPV is negative. Okay, so I will just be repeating because things have gotten too much messed up. Just see quick revision. I was asked to evaluate the financial acceptability, so it will be via NPV. I started NPV with investment, no sales, variable cost, fixed cost, direct pre-tax profits, which are after TAD. So I don't need to deduct TAD. It's pre-tax profit, tax, add back TAD. Then working capital could be no scrap, NCF. Problem is no discount factor. So for discount factor, you said, okay, no WACC is given. It's 40-60 debt to equity. So WACC equation, K into equity portion, KD debt portion. E was given, D was given, KE, RF plus RM minus RF beta equity. No beta equity was given. In fact, it was of proxy. So for beta equity of proxy, we got beta asset. Okay. Put that beta asset in our own results to get beta equity and get K. For KD minus T, it was redeemable IRR, market value after tax interest redemption. No market value was given. So present value of fallout was interest redemption discounted at KD. No KD was given, that was to be found. So I used the KDs available of 4 years, got the market value. Once put the market value, I got the KD1 minus the IRR. Through that, I got WACC and then I got NPV. Okay, so please copy this solution. Now, in this evaluate the financial acceptability, you just have to write one line. You can even check the official answer that since the NPV is negative, project is not financially acceptable. Okay. Now there is a 8-mark requirement. Discuss with reference to TONPANTAU's proposed investment. How real options build on traditional NPV analysis when evaluating investment decisions and the problems with incorporating and valuing real options. Your answer should make specific reference to Black-Scholes. Okay. So people say it's 8 marks or too much, not too much. 2 marks of 4 parts for 2 parts of 4 marks, sorry. 8 marks, or maybe 1 part of 3 marks, 1 part of 5 marks. Okay. This is a very, very easy requirement. The problems with incorporating and valuing real options, your answer should make specific reference to Black-Scholes. You have to write problems of valuing real options and specific reference to Black-Scholes. In this, you can write real options are valued using Black-Scholes model, which has a number of problems. And I have taught you problems of Black-Scholes. Okay. Black-Scholes assumes that model is European style option. Okay. Not an American style option. Okay. Similarly, Black-Scholes problem, the variables will remain constant. Okay. It cannot handle the changes. Okay. Similarly, Black-Scholes assumptions that no dividends are paid during the life of option. Okay. No transaction costs and taxes. So there is so much content that has been taught to you. You just have to remember that fact that we have to write this here. The problems of valuing real options, your answer should make reference to Black-Scholes. So you just need to write that real options are valued using Black-Scholes, but there are a number of problems with valuing real options through Black-Scholes, and write those 4 or 5 problems. European style options, okay, no transaction costs and taxes, no dividends are paid, variables will remain constant. Okay, so Black-Scholes problems are there. So this is a very easy part. And theoretical requirements are all about you gain maximum marks in that rather than trying to gain 100% marks. Okay. And even if you read the official answer, it has just stated this, the problems of incorporating and valuing real options. So it's written that real options are valued using Black-Scholes, and Black-Scholes has a number of problems. 4 problems of Black-Scholes. That's it. The first part, how real options build on traditional NPV. I'm not writing that because that has been taught to you. How real options build on traditional NPV analysis when evaluating investment decisions here. How real options build on traditional NPV. So you have to give some advantages and benefit of options. Okay. And discuss with reference to TONPANTAU. Okay. Here you can write TONPANTAU's directors feel decision to invest being made in phases and the possibility of not pursuing the investment further if sales of mathematics material disappointing are significant. So they think that decision to invest being made in phases, you are investing in phases, right? Year 1, year 2, year 3, and firstly the degree, then professional qualification. So decision to invest in phases is significant. And if initial sales are disappointing, you won't continue. This possibility is also significant. You are unsure how to incorporate these factors into investment appraisal, and directors are also uncertain about whether closest competitors have any plans to enter these markets or how its competitors will react. Okay, so you can write here. There are a lot of uncertainties in case of this investment decision. By directors, right? There are a lot of uncertainties. You can elaborate those uncertainties, that they don't know how competitors will react, whether they will enter. They don't know whether it will be successful. They're unsure that if initial sales are disappointing, they may take early exit. Okay, In case of uncertainties, there are many options like option 2, early exit, option of additional investment, traditional NPV analysis fails to incorporate these uncertainties in decision making. Therefore, use of real options in NPV help incorporate these uncertainties, hence making the company reach towards better decisions. How real options build on NPV? Okay, so there are many uncertainties in this case of TONPANTAU's investment. Traditional NPV analysis fails to incorporate these uncertainties. What will happen if competitor enters? What will competitor do? Whether we will exit or not. So there are many options in case of uncertainties like early exit, expand, delay. Okay, and traditional NPV analysis doesn't incorporate that. So options build on that NPV, incorporate these uncertainties, thereby helping the company reach better investment decisions. But they are valued using BSOP, which has a problems. You can elaborate this, you can write the drawbacks, because I'm just writing the main points here. And that would be it for this 8 marks. So problems, these points, 12 marks NPV would help you score good in this question. Hope you understood it clearly. Do read the examiner answers to get knowledge. Understand this point. Theory is all about how much knowledge you have. So by reading the examiner answers, you get more knowledge, help you write a better answer. Okay. We will meet in the next class with a new question. Thank you.